2 years ago, a guy named Marcus thought he was doing everything right. He had a nice car, a closet full of designer clothes, the newest phone every single year. On paper, to his friends, to his Instagram followers, Marcus looked rich. But when his bank sat him down and looked at his actual numbers, Marcus was worth negative $11,000. Not zero, negative. Meaning if he sold everything he owned today and paid off everything he owed, he would still be $11,000 in the hole. And here's the part that should scare you. Marcus isn't unusual. He's not a bad person, or lazy, or stupid. He made one specific mistake. A mistake almost every single person watching this video is making right now, today, without even realizing it. He didn't know the difference between something that makes you richer and something that just looks like it does. By the end of this video, you're going to know exactly what counts as a real asset, what's secretly draining your wealth while pretending to build it, and the simple formula that tells you, in 30 seconds, whether you're actually getting richer or just getting better at looking rich. Let's get into it. Here's something almost nobody says out loud. Most people have no idea what they're actually worth. Not their salary, not their job title, their actual number, what they own minus what they owe. And the reason is simple. We were never taught this. Not in high school, not in college. Most of us were never sitting at a kitchen table while someone explained, this is what builds your wealth and this is what quietly destroys it. So we default to guessing. We look at what we have, the car in the driveway, the shoes in the closet, the apartment with the nice view, and we assume that pile of stuff means we're doing fine. But here's the problem with that. Almost everything Marcus owned was doing one of two things. Either it was losing value every single day he owned it, or it was actively costing him money every single month just to keep it. That's not wealth. That's the illusion of wealth. And the gap between those two things, real wealth versus the illusion of wealth, comes down to one word, assets. So let's actually define it properly. No jargon. An asset is anything you own that has real financial value. Meaning, if you needed to, you could sell it and get cash for it. Or it's already putting cash into your pocket. That's it. That's the whole definition. 2 tests. Test 1, could I sell this for real money? Test 2, is this putting money into my account or taking money out of it? Let's go through real categories because this is where people get tripped up. Cash and savings. The money sitting in your checking account, your savings account, your emergency fund. This is the simplest asset there is. It's already cash. Investments. Your 401k, your IRA, stocks, bonds, mutual funds. Even if you're only putting in $50 a month, that's an asset because it has real market value and it can be sold or withdrawn. Real estate. The equity you actually own. This one trips people up constantly, so pay attention. If you own a home worth $300,000 and you still owe $250,000 on the mortgage, your asset isn't the $300,000. It's the $50,000, the part you actually own outright. That $50,000 is called equity, and equity is the asset. The rest still belongs to the bank. A business you own. If you run a business that generates income or could be sold, that ownership stake is an asset. Valuable property, jewelry, collectibles, certain vehicles that hold value. These can count, but only at realistic resale value, not what you paid for them. Now here's the sentence I need you to remember, because it's the one thing that separates people who build wealth from people who stay stuck. A real asset either grows in value over time or it puts money into your pocket. If it does neither, it's not an asset. It's just stuff. Let's go back to Marcus for a second, because this is exactly where his story splits in two. Marcus's car. He financed it. $45,000. Bought new, drove it off the lot. Here's what nobody told him. The moment he drove that car off the lot, it lost roughly 20% of its value. Just like that. Not because anything was wrong with it. New cars simply depreciate the second they become used. A year later, that $45,000 car was worth maybe $34,000. But Marcus still owed $38,000 on the loan. Read that again. The car was worth $34,000. He owed $38,000. That car wasn't an asset anymore. It was a liability wearing an asset's clothing. It looked like wealth in his driveway. But mathematically, it was making him poorer every single month, both through the loan payment and through the value it kept losing. This is the trap. It's not that Marcus was irresponsible. It's that nobody ever taught him the difference between something that feels like success and something that is success. The designer clothes, Same story, but faster. The moment you buy them, they lose almost all resale value. They cost money going out, and they put close to zero money coming back in. The newest phone every year. Pure liability, pure cost, zero return. None of these things are bad to own. This isn't a video telling you to live like a monk. It's about knowing what column each of these things actually belongs in. So you're making the choice with your eyes open instead of by accident. So what changed for Marcus? He didn't get a huge raise. He didn't win the lottery. He did one specific thing. He sat down and wrote out 2 lists. Everything he owned on one side, everything he owed on the other. For the first time, he could actually see the problem instead of just feeling vaguely uneasy about money. Here's the formula he used. And it's the same one I want you to use by the end of this video. Net worth equals sign total assets minus total liabilities. Add up everything you own that has real value. Subtract everything you owe. Whatever's left, that number, positive or negative, is your actual financial starting point. Marcus's number was negative 11,000. Painful to see. But here's the thing that most people miss. Seeing the real number wasn't the bad news. It was the good news. Because for the first time, he could actually do something about it. He sold the car and bought something reliable and paid off in cash for $8,000. That single move erased almost $30,000 of liability overnight. He redirected what used to be a car payment, $650 a month, into a retirement account. That $650 a month stopped being money that disappeared. It became an asset, growing every single month instead of shrinking. 18 months later, Marcus's net worth wasn't negative 11,000 anymore. It was positive 6,000. Not because he made more money, because he stopped confusing liabilities for assets. I'm not going to leave you with just a story. Here's exactly how to calculate your own number right now, today. Step 1. Grab a notebook or open a blank note on your phone. Write assets on one side. Step 2. List everything you own that passes the test. Sellable or putting money in your pocket. Checking and savings balances. Retirement accounts. Investments. The equity in your home or car. Remember, equity, not the full value. Add it all up. Step 3. On the other side, write liabilities. List every single thing you owe. Credit card balances. Student loans. Car loans. The remaining balance on your mortgage. Any personal loans. Add it all up. Step 4. Subtract. Assets minus liabilities. That's your net worth today. Now, a few important things before you do this. If your number is negative or lower than you hoped, that is completely normal, and it is not a verdict on you as a person. According to the Federal Reserve's Survey of Consumer Finances, many households, especially younger ones carrying student debt, start with a negative or low number. What matters isn't where you're starting. It's that you now know your actual starting line. Second, do this again in 3 months. Not every day, not every week. Net worth doesn't move daily, and checking obsessively will just stress you out. Quarterly is enough to see real progress. Third, and this is the single most useful thing in this entire video, every time you're about to make a big purchase, ask yourself the 2-question test. Will this hold value or put money in my pocket? Or will it just cost me money going forward? You don't have to say no to the second category. Just know, going in, which column it belongs to. Marcus's story isn't about a car or a bad decision. It's about a gap that almost everyone has. The gap between what we think we own and what we actually mathematically own. Closing that gap doesn't require a race. It doesn't require winning anything. It requires one honest list and the willingness to look at the real number. So here's what I want you to do before you close this video. Not tomorrow, right now, while it's fresh. Take out your notebook and write down your assets and your liabilities. Just start the list. You don't have to finish it perfectly today. In the next video, we're going to flip this around completely and break down liabilities, including the one kind of debt that's actually good for you and why not all debt is created equal. If this helped you see your money differently, hit subscribe so you don't miss it. And drop your net worth number in the comments. Positive, negative, doesn't matter. Half the people watching are in the exact same spot you are. I'll see you in the next one.